Fintech innovation and death of traditional banking system. The financial world is changing faster than ever before. For decades, traditional banks controlled how people saved money, transferred funds, took loans, and made payments. If you wanted to open an account, you had to visit a branch. If you wanted to transfer money, you filled out forms. Banking was slow, paper-based, and limited to office hours. But today, everything is different. With just a smartphone, people can transfer money, invest, take loans, buy insurance, and even trade stocks instantly. This transformation is powered by Fintech. Fintech stands for financial technology. It refers to companies that use modern technology to provide financial services faster, cheaper, and more conveniently than traditional banks. Instead of physical branches, Fintech companies operate through apps and digital platforms. Companies like PayPal, Stripe, Razorpay, and PhonePe have completely transformed digital payments. In India, the rise of UPI has made instant money transfers available 24/7 without visiting a bank. Fintech innovation includes digital wallets, peer-to-peer lending, robo-advisors, buy now pay later services, cryptocurrency exchanges, and neobanks. These services are built around speed, user experience, and low costs. Traditional banks, on the other hand, operate with heavy regulations, physical infrastructure, and legacy systems. Their processes are often slow and expensive. For example, loan approvals in traditional banks can take days or weeks, while fintech platforms can approve loans in minutes using AI-based credit scoring. This has led many experts to ask an important question: is fintech killing traditional banking? The answer is complex. Fintech is definitely disrupting traditional banks. It is taking away some of their most profitable services, especially payments and small loans. Digital wallets and UPI apps have reduced the need to carry cash or visit ATMs. Investment apps allow users to buy mutual funds and stocks without going through a bank advisor. However, traditional banks are not disappearing completely. Banks still play a critical role in the financial system. They hold customer deposits, provide large business loans, manage risk, and operate under strict government regulation. Central banks rely on traditional banks to maintain economic stability. Instead of dying, traditional banks are evolving. Many banks are now adopting digital transformation strategies. They are launching mobile banking apps, using artificial intelligence for fraud detection, offering instant digital loans, and partnering with fintech startups. This collaboration model is often called banking as a service. In India, banks work closely with digital payment platforms. Fintech companies provide technology, while banks provide the regulated financial infrastructure. This creates a hybrid system rather than a replacement. There are also risks in the fintech revolution. Cybersecurity threats are increasing. Data privacy concerns are growing. Cryptocurrency markets are highly volatile. Fintech companies may not always have the same regulatory protections as banks. Trust remains a key factor. Many people still trust traditional banks for large savings and long-term financial security. So, is fintech causing the death of traditional banking? Not exactly. Fintech is forcing banks to innovate. It is pushing them to become faster, more customer-friendly, and more technology-driven. Instead of eliminating banks, Fintech is reshaping them. The future of finance is likely to be a combination of both: strong regulated banks supported by agile technology-driven fintech platforms. In conclusion, fintech innovation is not the death of traditional banking. It is the transformation of banking. The financial industry is moving from physical branches to digital ecosystems. The institutions that adapt will survive and grow. Those that resist change may struggle. The real revolution is not about replacing banks, it is about reinventing them.